For people, it just is so. It's been so daunting. How about at the lows? At that point, a couple of weeks back, I know you're probably not. You've got a lot of different assets in the fund, not just equities, obviously. But it was harrowing a couple of weeks back. Did you think it was really going to get worse, or could it go back to the lows and get worse from here, David?
Oh yeah, it could get much worse. I think at the low point so far, at the end of March, we were down about 12%. I think right now, as of Friday, we're down about 8%. But we managed the fund to a 5-year rolling return. So if we earn more than 5%, we give the retirees a bonus. So right now, if we had no more performance for the year and we finished the fund being down 8%, we would still give the retirees a small bonus because our return would be about just north of 6%. So our time horizon is a 5-year time horizon. So we have an appetite that maybe is a little bit greater than other investors who maybe are managing quarter to quarter or year to year.
Hey, David, just a quick question. I mean, you're able to hand out bonuses when you perform well. That's pretty different than the state of a lot of different pension funds. I think of places like New Jersey and some of the others who have had so much pressure. Are you in that much of a better position than those other places? Do you perform better? What's your secret?
It's a structure. It's the structure. We have a promise that is easy to keep, and we can automatically reduce the payments if we earn less than 5%. So and we make the contributions. So it's a fully funded plan, and because of the risk sharing, all the constituents are aligned and have an interest in running the plan well.
You tell us about your asset mix. The bond market
Sure.
hasn't been kind to people in your position either. So I don't know where you're finding the good balance between return and safety that you need so desperately in a position like yours.
Yeah, well, it's not as dire as it seems. We have a pretty sophisticated structure, so we can move risk premiums and cash returns around. So right now we're being taxed about 2% on the bond side of the house, on the bond part of the equation. So bond returns are depressed by 200 basis points or more. So we're attracted to the risk premium. So we like the equity risk premium. We like the corporate bond risk premium. We like the high yield risk premium, excluding CCC. And so we can actually strip out the cash return and port the risk premiums on top of other risk premiums and get to a fairly honorable return. So as a result, our asset allocation is 64% risky assets or equity-like assets and 46% fixed income assets. When you add that up, that's 110%. So we end up with actually quite a lot more bonds than our peer funds. I think other funds would be 64%, 36%, and we're 64, 46. So by doing that, and again, because we're fully funded, we're able to absorb more risk. We can get to our target much more easily than other funds. It's a little bit of. It's a little bit of. I'm sorry, I was going to say it's a little bit of financial engineering, but we're able to do that with our structure.